Good morning, everyone. So today we'll continue with Ind AS 19 and we will see how do we account for defined benefit plan. Now, as far as defined benefit plans are concerned, this is one of the most complex aspect of the standard, and that is what is being tested more often in the examination. I hope my audio and video is clear. If you can just give a confirmation, also the screen. Sorry, let me just say. Okay, fine. So when it comes to defined benefit plan, what we need to understand is there is an employer, there is an employee. Employee provides service to the employer. Employer says, I will give you, for example, let's take gratuity. That will be, the most easiest one for us to understand how do we do the accounting for it. The employer says, I will pay you gratuity if you work for 5 years. So say, we are today year 0, 1, 2, 3, 4, 5. You work for all these 5 years. At the end of the 5th year, I will give you 15 days salary for every completed year. Now, when will we pay the amount? We will pay the amount after 5 years or after 5 years of completion or 6 years or 7 years, whatever it is. The amount will be based on this salary. The amount will be based on the 5th year salary. And once you complete these 5 years, you become entitled to gratuity. Now, please understand, the employee is providing a services for 5 years. So, whatever amount we pay here, that is for all these 5 years. That is for all these 5 years. Now, when we have to pay at the end of 5 years, let us say 15 days of salary for each year, what the standard says is we need to expense or provide for expenses in each of these 3 years. Now, how do we provide for these expenses? We call, or there is a method called projected unit credit method. So basically what it says is, out of whatever you will pay here, let us say here we will pay, for example, 50,000. They will pay, for example, 50,000. This 50,000 is pertaining to each of these years, let us say equally. So 10,000 this year, 10,000 this year, 10,000 for this year, 10,000 for this year, and 10,000 for this year. I am giving a simplistic example. Now 10 put together is 50, but we have to provide for expenses in each of this year. Now, can I say I'll provide expense of 10 in year 1? I cannot, because I am paying after 5 years. So this 10 I have to discount from year 5 to year 0. So similarly, this 10 I have to discount, this 10 I have to discount, this 10 I have to discount, this 10 I have to discount. After I discount all of these 10s, the amount that I will get in present value terms is called my defined benefit obligation. That is the part of my obligation, my liability. So what the entity does is, for this 10, now you are at end of year 1, year 2, year 3, year 4, year 5. You will discount it by 1 period, 2 period, 3 period, 4 periods. So 10 divided by 1 plus, let us say 10% to the power of 4. Similarly, to the power of 3, 2, 1 and 0. So this part you will provide for expense in year 1. Now sir, how will this become 10? Every year you will add interest. So first you will calculate the present value. Let us say 10,000 divided by 1 plus 0.1 to the power of 4. You get 6830. So year 1 expense will be 6830. How will this 6830 become 10,000? In year 2 to year 5, you will provide something called as interest, and that is how the amount will become 10,000, right? This is called projected unit credit method, based on which accounting for your defined benefit plan is done. Any doubt? Okay. Let's look at this illustration. With this illustration and example, you'll understand also few more other aspects related to our defined benefit plan. AJ Limited engaged in the business of trading of chemicals, having a net worth of 150 crores. Okay, company's profitability is good, and hence the company has introduced various benefits. So and so, the company is an associate of RJ Limited listed on Bombay Stock Exchange. This is basically for applicability of Ind AS, not relevant for the question. The company initially did not have any HR function, but over the last 2 years, the management has set up that function, and now HR department takes care of all these benefits. Okay, fine. One of the employee benefits involves a lump sum payment to the employee on termination of service that is equal to 1% of the final salary for each year of service. So, this is defined. Whatever is the final salary, you will get 1% of salary for each year, your final salary. Consider the salary in year 1 is 10,000 and assume to increase at 7% compounded each year. So, first year is 10,000. This will increase at what rate? This will increase at 7% every year. This will increase at 7% every year. Taking a discount at 10%, you are required to show benefits attributed year on year, obligation in respect of this benefit year on year, for an employee who is expected to leave at the end of year 5. So, that we have to take it. Following assumptions can be taken. There are no changes in actual assumptions. This will come to it subsequently. No additional adjustments are needed to reflect the probability that employee may leave the entity at an earlier or later date. So here basically what they are saying is, this is the relevant part of the question. 5 years, if the employee works for 5 years and leaves after 5 years, what will be the benefit that will be payable to that, and how will we define that? How will we define that to the, how will we define the benefit and how will we account for that benefit on year-to-year basis, right? Now, 1% of final salary for each year of service. Now, what will be the final salary? See, today we start at 100 or 10,000. This 10,000, it says they will grow by 7% each year. The 10,000 will grow by 7% each year. So, today it is 7,000. Today it is 10,000, end of year 1. End of year 2, end of year 3, end of year 4, end of year 5. 7% plus 7% plus 7% plus 7% means 4 times the salary will go up by 7%. So, what will be my final salary? Final salary is 10,000 into 10 to the power of, 10,000 into 1 plus 7% to the power of 4. So, 1.07 4 times. If you do 1.07 4 times, you get 1310796. So, this will be 13107, or that is approximately 13,100. Now, what will the employee get? The employee will get 1%, that is 131 of this for each completed year of service. So, every year the employee will get 131 for each year of completed service. So total becomes 655. Now when we have to account for this, see, this is the payment at the end of year 5. When we account for it in year 1, what we need to do is this, whatever is attributable to year 1, how much? 131. This 131 we have to calculate the present value. So 131 divided by 1.1 to the power of 4. Don't take 5. So why 4? Because we are doing end of year 1 and this is end of year 5. So 1, 2, 3, 4. Only 4 periods. So 131, if you do, take your calculators. 131 divided by 1.1 to the power of 4, you get 89.47. So this is the value. So the expense that you will provide is debit employee benefit 89, credit defined benefit obligation 89. Why are we crediting obligation and all? That will come to subsequently, but this is how you will do the accounting in the first year. Now in the second year, my liability is 89 because I have not yet paid. On this 89, I will earn, I will have to provide for interest because of the discounting angle. So interest on 89 into 10% becomes 8.9 rounded off to 9. So 89 plus 9 became 98. This is, so what you need to understand here is this 89 became 89 plus 9, 98, and 131 divided by 1.1 to the power of 3. So 131 divided by 1.1 to the power of 3, if you do, you also get 98. So this 98 is pertaining to this 131, and this 89 plus 9 is pertaining to the opening balance. Now 98 goes to the next year. You add interest at 10%. Now 196 plus 20, the interest, and this 108. Again you do 108 divided by 1.1 to the power of 2. Like this, when you keep on doing, you reach 653. The difference of 2 is because of rounding off, right? So now what the standard says is, this will be the expense that you will provide for each year, and this will be the interest cost that you will provide for each year. So for the current service cost, that is nothing but amount attributable divided by 1 plus r to the power of n. This gives us the current service cost, and opening balance into interest rate will give us the interest cost. So both interest cost and current service cost are provided for as expenses. Now, when we account for defined benefit plans, we make certain actuarial assumptions. Actuarial assumptions means how long will the employees serve? Say we do not know. Let's say we have 1 lakh employees. Will we know which employee will remain with us for 5 years? We will not know. So when we don't know which employee will remain with us for 5 years, we make certain assumptions. So actuary comes and says, let us say out of 1000 employees, only 900 employees will serve for the period of 5 years. That kind of assumptions are done by actuary. Then there could be actual gains or losses. For example, initially we estimated 900. Just a simple example. Subsequently it became 950. So because of changes in assumption, there could be gain or loss, and we measure it on a discounted basis. So actual assumptions can be your demographic assumptions, age of employee, mortality rate, how many employees will die during the service. See, these kind of assumptions also we need to make when we are doing the accounting. So don't worry, you don't need to do the accounting, calculation. You only need to do the accounting. Calculation will be done by the actuary. Then rate of employee turnover. Turnover means how many employees will resign and leave. Right. Then length of service, etc. Then some financial assumptions like discount rate, future salary. Because just now we saw after 5 years, whatever is the salary, at that salary we will have to pay the benefit. What will be the salary after 5 years? That also we need to estimate. Inflation rates, In case of medical benefits, what will the future medical cost? Now, medical benefits are something like, after a lot of companies provide after retirement healthcare services. So that is also covered here. Now, so that is the part related to actuarial assumption, right? Then another important component is discount rate. We need to discount. So just now we saw in the example, there is a future payable. There is a future payable. We discounted that to the present value. For that we will use the discount rate. Who will give the discount rate? The question will give the discount rate. Of course, actuary will give. In the examination, the question will provide you with the discount rate. So the rate which is used to discount the post-employment benefit obligation. See, obligation, when we are saying this is a liability, is determined by reference to market yields on government bonds at the end of the reporting period. If you have subsidiary, associate or JV which are outside India, you will calculate the discount rate by reference to market yields at the end of the reporting period on high quality corporate bonds. So if it is Indian, you will take market yields on government bonds, foreign market yields on high quality corporate bonds. Now, this is the most critical part, defined benefit obligation. There is a defined benefit plan where benefit is defined, and what is the meaning of that? It is the obligation, your liability under defined benefit plan. Then whenever we calculate the liability, we calculate present value of defined benefit plan. Present value means what is the present value of the obligation resulting from employee service in the current and prior period. So in the example that we just saw, this 89 is current and this opening balance plus interest comes from the previous period. This put together becomes my present value of defined benefit obligation. And if you want to cross check, for example, this 196 or this 324 or 475 or 653, this basically represents the present value of what is payable for these two periods at the end of the second year. At the end of the second year. Okay. So basically 131 is for each year into 2 for 2 years divided by 1.1 to the power of 3. So this becomes 196. This basically says for 2 years 131 into 2 discounted at 10% will give me 196, right? So that is the present value of defined benefit obligation. Now there are certain terminologies we need to understand so that our calculation becomes easier. Now what are those terminologies? First, DBO, we have already understood here, defined benefit obligation. The opening balance, this is present value of DBO. Then current service cost. Current service cost basically is if I provide 1 year of service, what will be the addition to the defined benefit obligation? So in our example earlier, it was present value of 130, present value of 131, right? So that becomes the current service cost. So in the first year it was 89, right? So that 89 became the current service cost. Then interest cost, on this you will provide 10% interest, that is 9, that becomes my interest cost. Then something there is called as past service cost. Now what is past service cost? Till now we did not have any plan, or earlier we had a plan which said, for example, employee has to provide 5 years of service. Now we are saying instead of 5 years you need to provide only 4 years of service. Historically, retrospectively, if you provide 4 years of service, we will give you benefit even if you complete 4 years of service. Now if 5 years condition was there, maybe 1000 employees were eligible. If 4 years becomes 1100 became eligible, right? Now this is something where you are paying extra for the services already completed. That is called the past service cost. Sometimes it can be a gain also, sometimes it can be a loss also, depending on the scenario. You will consider this, right? So here the format or the thing that you need to remember is we are calculating the DBO, and this is one of the questions which is frequently tested in the examination. We are calculating defined benefit obligation. For defined benefit obligation, first thing you start with is the opening balance. Then the interest cost, the interest cost on the defined benefit obligation. This will increase because interest increases my liability. The interest cost on the opening balance will increase my liability. Then whatever current service cost is there, that is whatever I need to pay to the employee because they have worked in the current period, that will also increase my liability. So in the examination, if at all you get confused, you just need to ask whether it will increase my liability or decrease my liability. So current service cost, every period the employee provides services, it increases my liability. Interest cost will increase my liability. Past service cost, if it is a expense item, it will increase my liability, otherwise it will reduce my liability. Then we have actuarial loss and gain. Now what is actuarial loss? Earlier the actuary said you have to pay to 95% of employees. Now he is saying you have to pay to 96% of employees. Means what? I have to pay more. If I have to pay more, is it a loss or a gain? It is a loss. So if there is a loss, that will increase my liability. Then just reverse of this actuarial gain. Then benefit payment. I have some liability of 1000. I have paid 100. Now whenever I make a payment, what will happen? My liability will come down. So you will reduce the benefit payment. Then there will be settlements. We will come to it later. If there is a settlement, please remember we are talking about a liability. If we are settling something with the employees, if it is a gain, it will reduce my liability. If it is a loss, it will increase my liability. Right? So whatever you do for DBO, you start with opening balance, add the current service cost, interest cost, past service cost, add actuarial loss, settlement loss, reduce actuarial gain, settlement gain, and reduce the payment part, which is done. Any question so far? Okay, no questions. Now, how do we account for it? Current service cost. Current service cost is an increase in present value of DBO resulting from the employee service during the current period. So every period when the employee provides services, whatever you add because of the service being provided, that is called current service cost. So you'll debit the employee benefit cost and credit the DBO. Interest cost. Interest cost is basically because we are calculating present value, every year we have to unwind the discount. Because you have discounted, we have to unwind the discount. So every year, what you increase in DBO due to passage of time. Here it is due to employee service. This becomes my interest cost. Then past service cost. Past service cost means what? Because of change in the present value of DBO for employee service in prior periods resulting from plan amendment or curtailment. Now, just now I gave you an example that earlier it was 5 years, now I am making it 4 years. I am increasing the benefit. That is a past service cost. Or curtailment. Curtailment could be earlier I said 5 years, now I said 6 years. So how can employer say that? Their wish, they can do it. It is their plan, they can revise the conditions whenever they want to do. So plan amendment is introduction or withdrawal or changes to a defined benefit plan. So either you have introduced a new plan or made some withdrawals or changes to an DBP, defined benefit plan. Curtailment is reduction. Reduction by the entity in the number of employees covered by a plan. So that's what. Earlier I said 5 years, now I am saying 6 years. If I increase the criteria to 6 years, the number of employees that would be covered would significantly go down, right? And hence there is a curtailment. An entity shall recognize past service cost as an expense at the earlier of the following dates: when the amendment takes place or when the entity recognizes related restructuring cost. Sometimes what happens when we learn Ind AS 37, we'll see restructuring cost. Now there under restructuring cost, what would happen? You may have to relocate certain employees, or you may have to fire some employees. At that point of time, if you are making certain amendment, you have to account for it on that particular date. So it may be positive or negative. Positive, increase in DBO, negative, reduction in DBO. Then gain or loss on settlement. As I told you, there could be settlement with employees. Settlement could be, I tell the employees, take this lump sum payment and we will not be entitled to, or we will not pay any further benefits. For example, I have to close down a plant, just for example. So what will I do? I say you are currently eligible for 100, and if you continue in your service, you will get more. But what I tell to the employees, you take this 120 and let us close the transaction. That means out of the defined benefit plans, if you are eligible for 100, I am paying you 120, but in future you will not be entitled to anything. Okay, so that is one. Or a settlement occurs when an entity enters into a transaction that eliminates all further legal or constructive obligation for part or all of the benefits provided under a DBP. So I'm telling the employee, you will settle it. Let's go. Sometimes call it one-time settlement. I get, instead of 100, I get my 90 also. Sometimes let us say employee has to work for 5 years. We are in the 4th year. We are closing down the plant. I'm telling the employee, for this 4 years, take some lump sum amount and let us close the benefit plan. Right? The gain or loss on settlement is the difference between the present value of DBP on the date of settlement and the settlement price. So whatever is the present value of DBP on the date of settlement, that is the DBO, defined benefit obligation present value, and whatever is the settlement, that will give you the gain or loss. If it is a loss, you will debit the cost. If it is a gain, you will credit the cost. Service cost that we say is the current service cost plus past service cost plus gain or loss on settlement. So current service cost means whatever the employee has provided in the current period, past service cost because of amendment, gain or loss on settlement, all this put together makes our service cost. So service cost will comprise of this cost, past service cost, and these two. Interest cost will be your interest part. Actual gain or loss will be your actuarial gains or losses. Now, what are actual gains or losses? Actual gains or losses are changes in the present value of the defined benefit obligation resulting from experience adjustment and effect of changes in actuarial assumption. Now, what does this mean? Experience adjustment means earlier I thought 5% employee will resign, but now I am thinking 4% will only resign. So this will result in actual gains or losses. Earlier if I say 95% employees will be entitled, now I am saying 90% will be entitled. So here I will have less entitlement. If I have less entitlement here, my actuarial, this will result in a actuarial gain. Now please remember, all actuarial gains or losses will be recognized in other comprehensive income. They will not be recognized in P&L. So actual gains or losses will be recognized in OCI only. Now, benefit payment. Benefit payment means I have accumulated something. One employee left, I pay him. So let us say 10,000 is the total DBO present value. One employee left, I paid him 1,000. So when I settle an amount to the employee, I will of course debit the liability and credit the bank account. Any questions so far? Let me plug in the charger. Okay, no questions. So in the total defined benefit cost, we have the service cost, current service, past service, loss and gain on settlement, statement of P&L, interest cost, statement of P&L. The reason we are using net is, we will understand subsequently, because we will have also something called as plan assets. Loss and gain on remeasurement, this is your basically actual gains or losses. This will go to your other comprehensive income. Right. Now, the remeasurement also comprises of two more aspects. One is actual gains or losses, we have already seen. Second, return on plan assets excluding amounts included in net interest on the net defined benefit liability, that is actual return minus expected return. Now, what does this mean? We need to understand the concept of plan assets. So, we have employer, we have employee, and there is a defined, let us say, gratuity fund, which is created so that when the employee retires, employer will make this contribution here and employee will say, the gratuity fund will settle it to the employee. Ultimately, the risk lies with the employer only. Right. Now, because you don't want a burden, on one fine day or on last day, there will be a lot of payouts. Every period they will contribute some amount. Let us say this employee is contributing 10,000 every year to this fund, contributing 10,000 each year to this fund, and on the settlement this fund will pay to the employee. Now please understand, it may be created as a separate fund or it may be kept within the entity as investment. The employer may be investing this part, that is also possible, right? Now this is what, if I am investing something for my payments to the employees, this is my, what do you call, asset. So on one side, let us say I have an asset of 10,000 and the other side I have a liability of, let us say, 15,000. Okay, so I have created an asset of 10,000. On liability I charge interest cost, on asset I have interest income. Sir, but asset can be investment, insurance, all of that. In that case, we will not get income. This, when I say interest income, this is an estimated expected percentage return. Okay, so whatever the company is keeping aside as asset, on that we earn income, and for accounting purpose we take expected return. For accounting purpose we take expected return. So we'll have the discount rate. Here you will have, let's say, 10% discount rate. Here you will have 10% return or 9% return. Considering this, we will compute the amount. Now, this is the expected return. Actual return may be, let us say, 11% or 15% or 6%. The difference between this 10% and 11% or 10% and 16%, that we will accumulate as remeasurement gains or losses. So, the return on plan assets, that is the gross amount, and the actual return. So basically actual return minus expected return, whatever is there, that is my remeasurement gains or loss, that will also be accumulated in other comprehensive income. Then so if you have to look at the number, opening balance of your DBO minus, so what, just a second. This part related to asset ceiling, we'll understand it subsequently, will not be able to understand now. So moving on, you have the opening balance, the net amount, add the current service cost, past service cost, net finance cost. This is interest expense minus interest income. Loss on settlement, if at all there is something, gain on settlement and benefits paid. So you will have expected closing balance. So what happens is, you take, let us say, the net liability. We'll take a question also. Opening balance of net liability, whatever is the number, Current service cost increases my liability. I will add it. Past service cost will increase my liability. Net finance cost will increase my liability. Loss and settlement will increase my liability. I will add all of these. Less. If there is gain on settlement or benefits paid, it will reduce my liability. So my expected closing balance is this number. But my actual closing balance is something else. The difference is my gain or loss on remeasurement, comprising of actuarial gains or losses, your expected versus actual return, and the asset selling part, which you will understand subsequently. Now, like we have defined benefit obligation, we have something called as plan asset. That is, the entity is making investments, or entity is setting aside some amount in plan assets. Plan assets are assets held by a long-term employee benefit fund and qualifying insurance policies. Now, let's say we have employer, employee, and we have the gratuity fund. Now, the investment that the entity is making, to qualify that as a plan asset, one thing what we need to understand is the gratuity fund should be separate. The entity, the gratuity fund that is holding the employee benefit plan, that should be separate. Okay, so this will be a separate entity. Okay, now any asset, see, ultimately this fund is created to settle the amount to the employee, and the employer contributes some amount to this fund. But if there is any liability, the risk, or if there is any liability left over, then the employer has to make good. If any surplus is there, it goes back to the employer. So whatever this gratuity fund invests, in other assets. Let us say they make some investments in government securities. Okay, these investments in government securities are called plan assets, but provided this gratuity fund must be a separate entity. It must be a separate entity, and this fund exists only to pay the benefits to the employees, right? That is one. And whatever the money is there, whatever the amount is there, this amount will be used only and only to pay to the employees. This amount will not be paid back to the employer. Even if there is a liquidation, even if there is a bankruptcy, you will not be returning back to the employer. So for example, this employer is under some financial crisis. You cannot use the money here, unless if for this fund liabilities, let us say 1000, asset is, let us say, 1200. Extra 200 can be paid back to the employer. But if, let us say, the liability is 800, asset is 800, and this employer went bankrupt, you cannot use this asset to settle the creditors. So whatever is with the fund will be with the fund only. That is what is called a plan asset. So plan asset held by a long-term employee fund. Assets that are held by an entity that is legally separate from the reporting entity and exists solely to pay or fund the employee benefits, and those are available to be used only to pay or fund the employee benefits, and are not available to the reporting entity's own creditors even in case of bankruptcy, and cannot be returned to the reporting entity unless the remaining assets of the fund are sufficient to meet all the related benefit obligation, or the assets are returned to the reporting entity to reimburse it for the employee's benefit already paid. So what does this mean? Basically, it means that either I have sufficient assets to pay the obligations, in that case you can return the money, or if the employer has directly settled some benefit, you can reimburse that benefit directly. Okay, so these are called the plan asset. Now here we will not include non-transferable financial instrument issued by the reporting entity, meaning to say, if the entity has issued, let us say, some non-transferable shares to the fund. Now this fund has the shares, those are assets, but those are not included in plan assets. Then qualifying insurance policy. So a lot of time what happens is, the company does not want to take the headache of managing all of these employee benefit plans. So what the entity does, it takes certain insurance policy. It goes to LIC and says, I have 1,000 employees, please give me an insurance that will cover my gratuity obligations. So LIC will issue a policy, and whenever there is a settlement, that policy will be used to pay the amount. Again, insurance policy issued by the insurer that is not related party of the reporting entity. It has to be by a non-related party, and the proceeds of the policy can be used only to pay or fund the employee benefits under a DBP and are not available to the reporting entity's own creditors even in case of bankruptcy. So same logic, you can either have your investment plan assets or you can have insurance policies. These two are the broad aspects of plan assets. Now, whenever the employer contributes to the fund, you will debit plan assets, credit bank, because you are creating an asset. And whenever employees are paid by the fund, you will reduce the benefit obligation and plan asset. Now see the accounting. Employer, fund. When you make contributions, debit plan asset, credit bank. Right? Then this fund will have debit bank, credit contribution. Now, when the fund settles, fund will say debit obligations, credit bank. Now, employer will not say credit bank because bank is already credited here. So, from this plan asset you will reduce. So, you will debit the employee benefit obligation and credit the plan asset. Any questions? Okay, no questions. Now, whatever plan assets we have, see, these are our investments. Those investments will give us money or return. So, whatever is the interest income, dividend, other income that is derived from plan asset minus any cost and tax payable by the plan. So, cost of managing plan asset means you may take some investment advisory or brokerage and all of that. The net amount is the return on plan asset. You will debit to plan asset, credit to employee benefit cost. Now, please understand, when there was a DBO, defined benefit obligation, there was interest cost. This interest cost was my expense. Here, this gain, whatever the interest income that I am earning, that I will credit to the employee benefit cost because that is my income, that is my return. Now, we talked about DBO, this is my liability. We talked about plan asset, this is my asset. If liability is more than asset, there is a deficit, it is a net liability. If liability is less than plan asset, there is a surplus, this is a net asset. The other way to understand is, if asset is greater than obligation, we say overfunded plan. If asset is less than the obligation, we say underfunded plan. Let's look at this example. RKA Private Limited is an old company established in some year. The company started with a very small capital base and today it's one of the leading companies and annual turnover was going, so it's okay. The company has a large employee base. The company provided DBP to its employees. The following is the information relating to the balances of the fund assets and liabilities on 1st of April and 31st of March. Present value of defined benefit obligations on 1st of April 1400, 31st of March 1580. Present value of plan asset 11401275. For the financial year ended 31st March, service cost was 55 lakhs. Company made a contribution to 111 lakhs to the plan. No benefits paid during the year. Consider a discount rate of 8%. You are required to compute the balances of the company to be included in its balance sheet as in 31st March and amounts to be recognized in the statement of P&L and OCI for the year ended 31st March. Give the journal entries in respect of the amounts to be recognized. Now, there are two ways to approach this. One on a net basis, another one on a gross basis. Either ways you can do. Right. Now, obligation. Right. Now, what is my obligation? Opening obligation is 1400 minus 1140. So 1400 minus 1140, it is 6260. Closing obligation is 1580 minus 1275. So 1580 minus 1275, 5. 0, 3, 305. So my closing net defined liability is 305. And how has the movement happened? Discount rate is 8%. So what you need to do is, I'll do it here. Discount rate is 8%. On that 260 into 8%, you get 20.8. You can round it off to 21, or you can present it at 20.8. Right. This is the net interest cost. Please remember, opening is a liability. This is a liability, so you'll have an interest cost. Right. Now, if you break this down, you have 1400 into 8%. That is your 1400 into 8%, 112. So here is my cost, and 1140 into 8%, 91.2 is my income. Okay. Now, one thing that you have to keep in mind here is, on the opening balance, whatever you calculate, your interest expense, your interest cost, interest by income and all of that you will calculate on the opening balance only. So what is the opening balance? 1400 opening balance. So 1400 plus 1140, you will consider that, and on that you will calculate the interest income and the interest cost. Okay, that is the first part. Now, the net amount, if you see, or the defined benefit obligation account, if you see, opening balance 1400, that is the opening balance of DBO. Then the question said that they have a current service cost of 55. Current service cost will increase my DBO. So what I will do, 1400, I prefer a statement format, not a ledger format, plus 55. Then plus interest cost will also increase my DBO, 112. Right. Now 1400 plus 55 plus 112, 1400 plus 55 plus 112, it is 1567. But what is the closing balance? 1580. My expected closing balance is 1567. Actual closing balance is 1580. My liability is higher. So this difference of 13 is the actuarial loss, which is the remeasurement loss. Right. Now, where will I take this actuarial loss? To OCI. Same way. You can do it on statement basis. What I said I prefer. Same way. For plan asset, opening balance 1140, interest cash contribution 111, they have contributed. Then actual return, this 24 is the balancing figure. So 1140 plus 111, it should have been 1521. It became 1275. So the difference between the expected closing balance and actual closing balance, this will give me the actual return. What is the actual return? Actual return is 24. Right? Actual return is 24. Now, one more thing that you have to understand here is, my expected return is how much? We calculated 91.2 somewhere. Expected return is 91.2. So Actual return is 94, 91.2 or 91 is my expected return. The difference between these two is my remeasurement loss. Where will I take this remeasurement loss? 91 minus 24, 67, which is my remeasurement loss, will be taken to OCI. The actual return of 24 will be taken to P&L. So, in the P&L, I will take the service cost of 55, that is given in the question. Net interest is what? Expected interest on liability minus asset, which is 21. That will take to P&L. Then in OCI, we will take the remeasurement aspect. Now, what are the two remeasurement aspects of OCI? One is 13 here, another one is this 67. So 67 minus 13, 67 plus 13, we have 70, 80. 80 will be taken to other comprehensive income. 80 will be taken to other comprehensive income. Now, if you break this down again, my expected return on liability, how much was that? 112. On asset, how much was that? 91. So 112 minus 91, 21. This is my expected return. That 21 goes to P&L. Now, what is my actual return? Actual return is, so if you look at asset, expected is 91, actual is only 24. 24. Now, the difference between these two, I was expecting 91, I got only 24, so I got less return. This is a loss. So 91 minus 24, 67. This will be taken to OCI, and whatever is the closing balance difference, the balancing figure here, actual loss, this 13 will be taken to OCI. So 13 plus 67, 80 will go to OCI, you will debit OCI. P&L, this is your current service cost of 55 plus 21. Cash contribution that is being made, which will increase my asset, and the increase in liability, 45. So this 45 is nothing but your increase in the net liability, that is from 260 to 305, liability has increased by 45, and that is the entry for this. Now, another way to calculate this, slightly simpler way, I would say, or to make it less confusing for you guys, what you can do is you can take the net defined benefit obligation or liability, net opening balance. Opening balance of net DBO, just a second, I'll pick the number. Opening balance of the the net opening balance or net liability is 1400 minus 1140, which is 260. Okay. Interest you will add at how much? 8%. You get 21. Then service cost will increase my liability. Add service cost of 55. Service cost will increase my liability. So you will add that service cost to the total liability, right? Then 260 plus 21 plus 55. Then you made contribution to plan assets. Now plan asset, if I make a contribution, that will reduce my net liability because I made some contributions to the asset. My plan asset has increased, so it will reduce. Minus contribution 111 is what they have said. So 260 plus 21 plus 55 minus 111. You have 225. Right. Now this 225, what does this represent? This 225 represents what is my expected liability. My expected closing balance is 225. What is my actual closing balance? Actual closing balance as per the question is 1580 minus 1275, that is 305. So my liabilities would have been 225, but it is 305. The difference of 80, this is nothing but remeasurement. And this we have split between liability and asset separately in the working above. I hope it is clear. Right, so this is how we calculate the defined benefit plan related contribute. How we do the calculations for defined benefit plans. Now, for you for the examination, you have to master this table. And this table. Okay, if you do these two, most of the questions you'll be able to handle easily in the examination. Now, one more aspect here is for assets, it is simple. What is the opening balance plus contributions minus payments? This will be the expected balance. This you will compare with the actual balance, and the difference will be your actual return. The actual return minus the expected return will be taken to P&L. Okay. Another way to do that is opening balance plus contribution minus payments plus expected return. So here you can add plus expected return. Then you compare that with actual balance. Whatever the difference comes is your remeasurement loss. Right. So we'll conclude here, and we'll continue tomorrow with the balance portion.